Security. Earnings hell. What does that look like, Mike?
Well, you had earnings hell in the first quarter for the banks, and it looks like there'll be more earnings hell for the banks in the second quarter. You have the three R's. You have a recession. And look, consumer spending's down, 1/3 by some estimates. So if the economy is 60% the consumer, that's GDP down 20% right off the bat. So that's hard. You have the second R, reserves, and you need higher reserves for problem loan losses, which we have going up 2 to 3 times. You have retail, restaurants, hotel, airlines, healthcare, and yes, energy, as you mentioned. And the third R would be rates. There's no escaping the negative impact of the Fed rate reduction. So that's earnings hell. Earnings hell means it's a harsh recession. We've lowered estimates now 5 times since earlier this year, and it's going to be just a tough time. Now, there's different scenarios for getting out of this. We are not modeling a V recovery. We are not modeling an L, which would be recession plus Japan, but we are modeling a deep U recovery. Now, there are some mitigating factors, but I'll pause there because there's certainly some bad news.
Well, I think more and more of the folks we seem to be hearing from are in the camp of a longer recovery rather than a quicker recovery. The banking world is a big one. It has lots of parts and subparts. Where is this wave of trouble going to crash the hardest? Which companies, which types of banks?
Well, what's interesting here is, Goliath is winning. The larger banks seem more resilient than the rest of the industry, and that's a change versus the past half century. When you look at the largest banks, number one, there's a huge war chest. And this war chest is you have the biggest buildup of reserves for problem loans before a recession in history. They have enough reserves to cover 1/2 of the losses that you saw during the global financial crisis. Second, the government has a kitchen sink effort to revive the economy. So you're seeing more proactive regulators, Treasury, Congress. I mean, when you look at the Fed increasing its balance sheet and additional government debt over a year or two, that could be $10 trillion thrown at a $20 trillion economy. That's pretty powerful, and they'll need the largest banks to help implement that. And then when you look at the resiliency, operationally, the largest banks are open for business. 3 out of 4 employees are working from home. The largest banks are stepping in, doing their job. You're seeing a flight to quality benefit. The largest banks have deposits and loans up 6 to 7% in just the last 3 months. And by the way, the fixed income market supports this view of resiliency. In fact, you see a dichotomy between the equity markets and the bond markets. The equity markets say that the sky is falling and banks are in deep trouble, whereas the bond markets say that banks are pretty fine, just like any other company. So I find that fascinating, actually. And remember, Tyler, during the global financial crisis, the bond markets got it right and the equity markets got it wrong. So we'll see who's right this time. Right now, it looks like the fixed income markets could be right, but that's not what the stocks are saying today.